My name's Ashley Garner, and I am founder of ABG and Associates. And we, is Michael and I, Michael's on here and he'll say hello in a second. We're in the real estate business. And so I have a real estate brokerage team for a single family brokerage team that works with me. And I've been a single family broker for 20 years. And also, I'm heavily involved in the investing side of real estate. And it has grown from single families and duplexes and triplexes to a 10 unit place, a 32 unit place, a 35 unit place. And most recently, Michael and I closed on a 196 unit multifamily property in Jacksonville, North Carolina.
Are you still on the hunt right now, or are
Here
you
later
done
on.
acquiring?
Ooh,
Just questioning. Because I've got a few off market that kind of fit exactly what you are speaking about.
oh yeah, let's talk about that offline. Would love
Yes,
to
sir.
hear more. Yeah, sure. Michael, why don't you go ahead and say hello to everybody?
Hey everybody, Michael Crocefolia. I'm general partner of ABG Multifamily alongside Ashley. He just went through our rap sheet, our resume. I've been in multifamily for about 6 years, and I started up in the Northeast, up in Pennsylvania. Built a portfolio of about 35 units before I moved down to North Carolina about 2.5 years ago. Met Ashley 2 years ago, and we decided to kick off on the syndication journey together. It's great to meet you all, and I'm excited to talk about saving taxes with you.
All right. How about you, Bill?
Hi, my name is Bill Smith, and I've got some real estate investments from passive syndications to short-term rentals, and I specialize in cost segregation and have done work with Ashley on a number of projects for a number of years because he's grown and is currently working on this latest acquisition. What we do is help you not pay the federal government taxes. So I'm everybody's best friend who's a real estate investor.
That's right. And we're going to hear from Bill in some detail here later on in the slides. How about you, Rebecca?
I'm a commercial and residential realtor, born and
Okay.
raised in Nashville, and been in the business for about 22 years. Started with a home builder and started a home building company with two other men from the ground up in '08. That was acquired by Century Communities. So different background, very different. I never thought I would be an agent, but I am not your typical agent. I practice commercial and residential, and
Okay.
just that's about it. Working
Good
on
deal.
my CCIM. I've got my ALC.
Oh, nice. Awesome. All right. Dan?
Afternoon. Dan Neese. I'm with Intracoastal Realty in Wilmington, North Carolina. New to the real estate world and really just trying to just soak up as much as I can. So this is really out of curiosity and happy to be here.
Yeah, good deal. Happy to have you. Lisa, you might still be muted.
Yeah,
Sorry,
she's muted.
I am.
There
Can
you
you hear
go.
me now?
Yeah, gotcha.
Ashley and I go way back, and it's been really neat to watch his career just blossom. But I am an average real estate agent. This is my 12th year selling. I have one rental property and have an LLC, but I'd like to learn more, so that's why I'm here.
Okay, great. You're in the right spot. Happy to have you.
Thank you.
Let's see who's next on here. Rain. All right, let's keep going here. How about, and we got Rebecca. How about Siobhan? Hey.
Hello, hi. I'm new to real estate. Previously had my license in Chicago, where I'm from, but at that time I decided to stick with my current career, which is human resources. And so now I am taking a different approach with tax liens and wholesaling. So like I said, I'm just getting started. I'm still in my current career field of human resources. I am in Alabama, and so I'm just here to learn.
Okay, great.
Yes, roll tide. My son goes to
There
University
you
of
go, baby. That's good stuff. I'm from
Uh-oh.
Tennessee, but that was my undergrad. I got a lot of push for it, but it's okay.
I guess the
Okay.
SEC is well represented on the call. That's good. Okay. How about you, David? All right, there's David. Hey, David.
Multitasking, so I'm not on video.
Oh, that's all right.
And I'm a CPA entering month 2 of my real estate brokerage career and looking to invest in residential rental property here in Wilmington area or coastal Carolina.
Okay, great. Elle?
Hey guys, my name is Elle McGee. I'm a real estate developer in Georgia. So I specialize in finding land and building multifamily properties, duplexes, triplexes, and small apartments from the ground up, and just here to connect with some like-minded individuals. Glad to be here.
Yeah, awesome. How about Eugene? How about JPL? JPL Lang. All right, let's keep moving. What is that? Kirti? Yeah. Siobhan. How about you, Victor? You want to say hello?
Can you guys hear me?
Yeah, there you go.
Hey, how you doing? So, yeah, this is Victor with Intercoastal here at
Okay.
Topsail location. Residential is the main focus at this point in time, but I saw the email, thought I would definitely take a listen in to some interesting information and see how it goes.
Yeah, great. And how about you, Vlad? All right. Anybody else want to say hello that we missed? All right. Let's go ahead and get started in these slides so we can hopefully learn some things here. Let's see if I can get back to where I can see. All right. Can everybody see the slides okay?
Yep.
All right, good deal. Like I said, we're ABG and Associates, and this webinar is about how real estate professionals can unlock huge tax savings. And the first and maybe most important slide is this disclaimer. And Michael and I are not CPAs, attorneys, or tax advisors. We are not licensed to do any of that. We're not licensed to give financial advice, tax advice, legal advice. So each of you should know that you need to know that, and you need to know that everybody's situation is unique, and your responsibility certainly is to consult with your tax professional or your CPA. The purpose of today's video is that we bring this subject up so you will know to ask about that. This is something that's very powerful and can make a big impact on your life, but it affects everyone in a different way. So make sure that you ask and learn about what your situation is. Okay?
Same goes for me on that disclaimer.
All right, good deal. Yeah, we'll kill two birds with one stone there. All right, good deal. Okay, again, I'm Ashley, and we introduced ourselves already. A little bit more about me. I kind of grew up in this business in real estate for sure, but in rentals. When I was in high school and junior high, my dad started buying old houses and we subdivided them internally and rented them out to students at West Virginia University. So I've been in this business in a very hands-on way for a long time. Now it's different in that we treat it more like a business instead of just a very hands-on mom and pop fashion. That's really the only difference, but it's basically the same business, just scaled up on a larger platform. Michael, you want to say anything else?
Yeah, from my side, I'm the classic accidental landlord. So I bought an old abandoned restaurant back in Pennsylvania because my family was in the restaurant business. This was going back about 7 years ago. And we bought this to turn it into a second restaurant. And all of a sudden, the world shut down when COVID struck and restaurants were no longer open. And so we had to quickly pivot. But the silver lining of the property we bought was it had a 5,000 square foot warehouse, it had an unfinished apartment, and it had three trailers renting land in the back. So I was forced into this accidental landlord situation where I had to learn very quickly how to profit off of those other spaces while we couldn't run the restaurant. So that brought me into the multifamily game, and I haven't looked back since. And we definitely got out of restaurants after I learned how real estate worked.
Got it. Good deal. All right, let's see if we can get to the next one here. Sorry, I'm going back and forth, making sure I don't leave anybody out in that waiting room. All right, so why taxes matter in real estate? Taxes are one of the biggest drains on wealth, and everybody knows we work hard and we pay a lot of percentage of our income in taxes. And anytime you have a chance to save, taxes is a big deal. And it's important that we do it legally. And it's important to know that as real estate professionals, we have unique advantages that most other people don't when we invest in real estate. And so today is bringing to light the investment in real estate and how it benefits us as real estate professionals specifically. One of the key factors is depreciation. Real estate allows you to depreciate and take this paper loss, and we'll get into that more. But that's different than most other investments. Stocks, crypto, and things like that, you don't get that benefit of a loss in any of those things potentially against your ordinary income either. So that's why it becomes powerful. And this depreciation thing, and Bill's going to get into this a little bit too, of course, because that's his specialty. But the gist of it is this: other than the land, you can't depreciate the land. But when you buy a piece of real estate and it's got improvements on it, like buildings and sidewalks and parking lots, those things don't have a forever lifespan. They wear out, in other words. So the idea is that they are worth less as time goes on because they have wear and tear and they're not going to last forever. They're closer to the end of their life. That's basically the gist of the depreciation. And as we go forward in this talk today, you'll realize that certain things have different lifespans. Some things last longer than other things. And one of the most powerful features is to do this cost segregation study in which you break down each piece and you separate them into their lifespan, and it really allows that benefit to multiply. The IRS allows this. These are their rules. We're not making this up. We're just trying to understand the rules that they've given us and how we can best operate in this world. The idea, again, is that depreciation can reduce your taxable income, but it doesn't reduce the cash flow. So we do this to make money. And if we do it right, then we get a check in the mail every month in some fashion from this real estate. And that's your cash flow. Income is different than cash flow. And especially your taxable income is very different than cash flow. So our goal is to receive cash, but reduce our taxable income. That's our goal. There you go. Example, you collect rent, but you report a loss. Now, this is where it begins to talk about one of the benefits of being a real estate professional in the eyes of the IRS. So think about it this way. You've got buckets of income, and the IRS likes to keep things separated. So they like to have an ordinary income bucket, and then they like to have a passive income bucket. And the idea is that the incomes don't mix. And so a ordinary loss doesn't mix with a passive income, and a passive loss doesn't mix with an ordinary income. That's their idea. So in the case of real estate professionals like me and some of y'all, we sell a house or a building or a piece of land and we make a commission. That's an ordinary income. And when we have rental house or something else, typically that is a passive income or loss. And normally those things don't mix. Now, we're going to let Bill jump in here because in the case of a real estate professional, sometimes they can mix. And this is where you're going to have to talk to your own tax preparer to make sure that this is what happens in your own situation. But I can tell you from my experience, that's what happens in my situation. And it very well may be able to happen in your situation. And if it does, it's a big deal. And I can say that from personal experience. Bill, you want to take over
Sure.
here for a minute?
I'll have you flip
Okay.
the slides, but rep status, a lot of people will claim reps. They call me because I do depreciation and they think, oh, I can do this and go against my ordinary income. I got a W-2 and you really can't. So you really need rep status. So that's for people like Ashley or you as real estate professionals. And people think that anybody can claim it. It's not for lenders and handymen and things like that. You're not a default real estate professional by having a real estate license either for being, you're a real estate professional, but in the eyes of the IRS, you are not. So what it's really for is if you go to the next page, these things are excluded. There's some misunderstandings about what it means. And it's really about executing real property trades or business. And I think the next slide, we'll talk about that. And so what you need to do is that the IRS defines 11 specific types of real estate property trades. You do this: development, redevelopment, construction, reconstruction, acquisition. You guys can read all this. Rental, mostly it's operations and management. And sometimes you're not the one doing all those things, but you're managing it. So these are the activities that you need to do. Now, if you've got a real estate company, like you don't really have to track your hours because you are in the real estate business. If you're doing a few other things or you're an independent, just buying property, or you're a spouse. So here's an example. I have a lot of spouses. One of the spouses is a high earning doctor, lawyer, consultant making $1 million a year or more, or many hundreds of thousands or millions. And the other one says, we're going to buy real estate and you got to spend 750 hours at a minimum and you have to track it. and you have to do more than 51% of your work time. So if you've got a W-2, a 40-hour job, as he sees it, you're not going to qualify for rep status. That's why the spouse will always do it. They have time, and then they offset that $1 million worth of income. I have so many clients like that that are doing it, whether with Airbnbs or multifamily. Multifamily is big. So you're obviously doing this, you're developing. If you're not, you should be. You need a new CPA. So I tell people all the time, they go, my CPA never told me this. They don't necessarily know it specifically unless they're a real estate CPA. And I'm sure you've been doing this, so you've got this going down already, I'm sure. But a lot of people don't. So the next slide will tell you some more criteria about that. But the key thing is 750 hours, track it if the IRS comes knocking, and you need to more than 51% of your work time. So some of these spouses are raising kids, and that's a lot of work time and the most important work time, but they don't have another job. So this kind of talks about some of the criteria. I don't need to read bullets. You guys can read that, but you just need to materially participate in your properties. And there's the 750 hours, 51% of your time. And if you've got a W-2, that's definitely going to trigger an audit. So if you claim rep status and you're a W-2, not your spouse, on your joint return, it's going to trigger an audit. And everybody loses. Only one time as a guy won on that one, but there's a lot of case law about this. And we can talk about that. You claim status, basically, it's your CPA, and it's just a checkbox in your return. As long as your CPA is good with that, then we can take depreciation on your developments. We can talk offline afterwards and really talk about your properties and how much money you can save. And I think we have a couple of examples of how it works. So that's the key criteria if you're in the real estate business. And if you're a realtor or something, like 500 hours of some of your time in some of those real estate services can count for, if you're in the real estate business, towards your 750 hours. Because most of time when you're a realtor, you're on a 1099 schedule anyway, not a W-2. Using lender examples, and I looked at this one for a while. Let's see. The lender's not part of that. Here's tax court cases. So you just you need to just follow the law. The key thing is follow the law. Lenders really can't claim reps on taxes, and a lot of them do, and they get audited, and they're going to get in trouble. But getting the audit is a slight chance. So let's see. I think we have the next one that talks about some of the other stuff. I don't like to talk about that. Who does generally qualify for real estate trade or business? Realtors, brokers, flippers, wholesalers, property managers, general contractors who construct new buildings, apartments, things, right? Developers. So it could be confusing and complex. It says there's documents about it. I've got a document about it from a CPA that I work with a lot of work for. Anyone wants to contact me afterwards, I can share you the rules. It's like a 30 or 40 page document. It really goes through some of the things. But if you're a flipper, and when you use depreciation, I mean, your rep status, your depreciation can help offset your income, but you may not want to do cost seg on all those. And no, I'm not a CPA. I just play one on TV. That's why I did this thing. But I've been doing this for 13 years, so I know more about this than most CPAs. So that's the key for this. Any questions about that, I'm happy to answer here, chat them, speak out, or online, because that's the best way to learn is to ask questions.
Yeah, anybody have any questions about whether they are or are not? And again, we're not here to make the designation, but Bill may have some firsthand experience to direct you.
Yeah. And I know CPAs that specialize in this. So I got people in my Rolodex that can be helpful if you need that assistance.
Yes, I was just going to ask Bill, how do we get your information so that I can connect with you offline? Because I've developed over 10 projects and this is my first time hearing about this. So now I'm afraid that I've been paying too much in taxes.
That's a great history. You've done this for a while. So we'll look at the best time to do it is year in service. So I asked you just put this thing in service. We're doing the inspection. I think next week or something, we're going out to inspect the property
on Wednesday.
Soon. He just closed this year, so he got 100% bonus. So we look at the year you did it. But if you didn't do it and your CPA was not aware of that a few years ago, and there's enough in there, we can do it today. And you don't have to amend past taxes. You do what's called Form 3115 and carry that losses forward. And we can give you losses where you won't pay taxes for a long time on a federal level. I said you're in Georgia, so you still got state taxes. This is federal, so you still got state. And so that's one of the things that you want to do. So my contact information, Ashley may share it, but it's BILL at ELB, that's Edward Larry Boy, costseg.com. My phone number, and you'll share this maybe after, is 480 747 5547. Now, that's an Arizona area code, but I live in Richmond, Virginia. But in the morning, I'm flying to Arizona for a week. See my new grandbaby, my grandson, and there's that's all right there. So anybody needs that, take care of that. And I'll be working next week remote, but you spend some time with that little baby. He's so cute.
Good for you.
I'm doing
Congrats
some
on your
property
grandkid.
inspections while I'm out there. I've got clients out there. So if I don't get back to you right away, it's because I'm on a plane all day.
Gotcha. All right. Thank you, Bill. So stick around. We're going to go through some more slides, but I have a feeling people will have some questions for you. So hang
Sure.
tight there. Oh yeah. You know what? Why don't you just talk about this one real quick, Bill? This is the last slide that I threw in there for you.
Yeah, I love this one. So
yeah.
people talk about straight line because right now you're taking straight line. You divide your property by 27 and a half years. It's just real estate, 27 and straight line.
That's the default, right? So if you don't do anything to change it, that's the way the IRS is going to treat your real estate. Is that correct?
That's correct. I mean, your CPAs is to put on there at 27 and a half years if it's residential or residential oriented. Even multifamily is like a commercial, but it's residential. You need to be like a restaurant or a commercial building or an office building to get 39 year, or an Airbnb gets 39 year. And I can explain that later when we do short-term rentals. But straight line is just, there's a Big Mac, but when straight line, you don't see the parts and pieces. It's just that little magnet. You just see the plain old hamburger. Looks at the building as a whole. There's nothing broken out. What cost segregation does is it uses what's called MAKERS, Modified Accounting Cost Recovery System, not the bourbon makers. It's accounting methods, been since 86, which breaks down the building into, everybody knows the song, to all beef patty, special sauce, lettuce, cheese, pickles, onions on a sesame seed bun. So it's parts and pieces. And each one has a different tax life, as Ashley said earlier. So all these components can have a different tax life. So there's the structural components that are going to be still 27 and a half or 39 years. And there's the non-structural or specialty components that are going to be 5, 7, and 15, which are landscaping, specialty flooring, specialty lighting, electrical plumbing, different things like that. There's the core things you need for a building, but the building bling, for lack of a better term, that's where you see where we break down the methods, and then you just have a shorter tax life, which gives you more deductions, which means you pay less taxes and increase your cash flow, as Ashley talked about. So that's how it breaks down.
Okay. Thank you, Bill. All right, maybe we'll do a couple examples. And then, by the way, if any of you have your own investments and you have a question about how this can affect you, then we'll talk about that too. You're a real estate professional, you're earning a commission or a fee or an income of some kind. And you're also a real estate professional who owns some real estate asset that's producing cash flow. All right, so now you've got your losses from your multifamily depreciation, and that can flow into the ordinary income bucket. And so when a loss flows into that bucket, the income fills the bucket up. That's what they tax you on. And when you put a loss in there, it brings that income back down, that taxable income. It doesn't change the cash that you receive. It just changes the calculation on your tax return on how much income that you have to pay tax on. So the net result is you have a significant tax savings. And again, I have been a first-hand beneficiary of this. There have been investors that have been in the projects that I promote who are real estate professionals. And I remember specifically seeing one of these people the day that they finally filed their taxes. This was like 2 years ago. And this person ran across the parking lot and almost gave me a big hug because they're like, oh my gosh, this made such a difference on my taxes. And it's really amazing.
It doesn't even have to be like a lot of transactions. Like I've done this 4 separate times, the cost segregation studies, but when you do it the first time, there's a huge benefit and you see it right away. So even if it's a small project, if it makes sense and you're holding on to the asset for a little bit, talk with somebody like Bill who specializes in that. They'll give you firsthand look at a proposal of what the depreciation schedule would look like before you sign up for it so that you can determine if it makes sense. But Bill and I are working on one right now that's going to be 400,000 worth of depreciation in year one. It's a decent sized asset, but it's not huge.
And that's something, Michael, you're buying to use as like an Airbnb short-term rental, right?
Yep, it's a duplex.
Okay, good. Yeah, I put this slide in here. It's intuitive. A multifamily what I do and Michael does, but the only difference is it's just bigger. That's all. So the numbers are bigger numbers, but it's still the same thing as Michael's using on his duplex. It's the same thing you could use if you wanted to on a single family or an office building or any kind of self-storage or whatever it is that you're into. You can't depreciate land, but the improvements you can depreciate. Okay. And
Can't
it's more
cash flow land either. I said you can't cash flow land either.
Yeah, land doesn't tend to cash flow very well. That's
I
exactly right.
know.
Yeah, that's a very good point. All right, so this is an example, by the way. Michael just mentioned the proposal. This is a screenshot from the actual proposal that Bill and his company prepared for us on the Bryn Mawr Village, the 196 unit property that I mentioned. So we bought it in 2025. We said, hey, Bill, we bought this property. We'd like to do a cost segregation study. Can you give us a proposal? And this is just a small screenshot of it. And they're sending their engineer to the property on Wednesday, and they're going to go through and do the study, and they're going to look and say, oh, it's got this many light switches, and it's got this much asphalt in the parking lot, and this many squares of roof shingles, and it's a big, thorough report. And Bill, you might want to chime in here too, but the gist of it is that they give a conservative proposal and an optimistic number here. So you can see the year one tax benefit range, like 2.9 million up to 5 million. And what that means is that if you owned all of this building yourself, you own 100% of it, and assume that you were 37% tax bracket, your cash value saved on taxes would be somewhere between $1 million and $1.8 million. Now, Bill, did I explain that correctly?
Yeah, so when we give a conservative and optimistic, we look at the range of like properties, and usually we're somewhere in the middle. Sometimes we exceed the optimistic. But we look at the net cash benefit, the net cash flow, we assume a 37% tax bracket. So 2.923 million times 0.37 is 1,800,000. So that's what you're not paying the IRS. Anytime you have a deduction, whatever your tax bracket is, whether it's 25%, 37%, whatever. So if you are a real estate professional or you have a business and you're paying estimated like UL and quarterly, when you have this depreciation applied, your estimated taxes go away or significantly reduced depending on your tax burden, which again, that's the cash flow strategy as I talked about. So then you have that cash, you're not paying the IRS, so you have more cash to buy more assets or do renovations, repairs, upgrade your property. So that's how that works. And then on a syndication, on a multiple investors, let's say we hit the 5 million, then based on the percentage of ownership, that kind of is passed out to the investor. So the first thing that happens, let's say it was near year end and there was only $9,745 of net income after all the expenses, new property, everything's bought. So there wasn't that much income in the first year. It was bought like in December, let's just say. So then there's 5 million left over. So the first thing depreciation does is wipes out the income, and then that 5 million split between the investors and a K with that big loss that Ashley talked about earlier. And then you put this against your taxes, and you're like, woo, but you've got to be a real estate professional. You got to be able to use it. Now, the one other thing, if you have an adjusted gross income of or less, you can use $24,000 worth of depreciation per year if you were in a syndication to offset that. So you might have been invested, but maybe there's not a high adjusted gross income. So you can use that 24,000 and up from to 150. This is without real estate professional status. That number, that 24,000 goes down to zero. It scales down. For real estate professional, that entire amount is going to be applied to your income. You say, I only made $1 million and I got 5 million in depreciation. That 4 million will carry forward to future years. You'll show a paper loss of 4 million, but you've made in cash flow. Then that next 4 years, it just carries forward. So you don't ever lose this if you don't use it in year one. And we're back into what's called 100% bonus depreciation with the one big beautiful bill, which makes this so real estate people don't pay taxes.
Rebecca, did you have a question?
I do. Is this kind of the same similar concept to carry forwards if there was a loss?
Yes, carry forward losses, net operating loss, carry forward loss, suspended loss, exactly. So it reside on form 81, 85 or 85, something. It's just there. So it will carry forward for an additional 19 years because there's 20 years you're allowed to do it. Now, Most people will
Okay.
use that up in that time, but you don't lose it. And then if you happen to sell and there's capital gains on another
Right.
property, you can use that unused depreciation carry forward to offset capital gains. That's a passive gain. There's passive losses, passive gains.
So
Thank you.
practically speaking, if I'm a real estate broker and the end of the 2025 tax year is coming around and I'm staring down the barrel of, say I had $300,000 worth of gross commissions, but I have to set aside 37% for taxes, right? So if I have money left over sitting in a savings account right now and I invested it in a deal like Bryn Mawr, you actually start to shelter that income. So you can quickly protect that 37% that you owe the government by investing in a syndication, and it's generating cash flow and appreciation for you in the future.
Yep. It's so powerful. A couple of points to make sure that we understand. If you're not a real estate professional, you can still do this. You still have the losses, but it can only apply to your passive income, or it can only offset your passive income. It can't offset what you might make from managing your rentals or commission on your brokerage income. That's the main difference. If you're not a designated REP, real estate professional, then you're still paying ordinary income tax rate on your ordinary income. And this doesn't change that. But if you are a real estate professional, that's the real benefit. The other thing to just reinforce that both Michael and Bill just said is that you don't lose these things. So even if you are a real estate professional, and say you get a loss that's this year that's bigger than any of the income that you have, like you don't, in other words, you don't use it all up. It's okay. It stays there. You get to use it in the future. Let's give an example. If you're not a real estate professional and you invest in this Bryn Mawr Village, and that's the only thing you got, and you're not a real estate professional, you're going to be making income on the investment over the hold period, which in this case is 5 years. And then you're going to be making money when we sell the asset because you're going to get your share. It's theoretically possible then that you could receive the cash flow for that whole time and pay very little or no tax on what you get from that one investment. So just because you don't have all this stuff, or if you think you don't have a whole bunch and it's not worth the hassle, it really is worth the hassle because it does, you don't lose it. It doesn't go away.
And as I mentioned, if you invested in one of these syndications and you're not a real estate professional, if your adjusted gross income is 100,000, after you do all your expenses, 100,000 or less, you can use up to 24,000 against your income. So there are ways to use it when you're not at the 300, 400,000. You're saying if something had an off year, some other area, you're just investing in whatever. So there are ways to use it. And there's another strategy we're going to talk about in a minute too, I think.
Yeah, good, good. All right, so let's move on from that one. This is a slide that is very powerful, in my opinion. And I think rather than looking at the actual percentages, I like to put things in a graph. I like to keep things real simple. So let's use this Bryn Mawr Village as an example, but this applies to whatever you're investing in. So normally people will analyze an investment by looking at these three returns here, the cash on cash, or the R, which is average annual return, or the IRR, which is internal rate of return. And I made a column here called the base case. And then you'll see the column with depreciation before recapture, with depreciation after recapture. And so say we're marketing and you have an opportunity to invest in the Bryn Mawr Village property, and we can expect a 6.5 average cash on cash return and a 22% average annual return. And those are really good returns. Now, Bill's company comes out, we do the cost segregation study, and then we take our bonus depreciation, first year, 100% of it, and then look at what happens to these returns. So your cash on cash goes from 6.5 up to somewhere between 12 and 14. Your average annual goes from 22 up to almost 30. And that's huge. And so then you say, well, wait a minute. You guys are only going to hold this thing for 5 years, and then you're going to sell it. And you've already taken all this depreciation. So that's when the IRS says, we're not going to let you have the whole benefit of that if you sold it and you took all of the whole life of it in the first year. So we're going to do something called recapture. Recaptures is a different rate than your 37% tax rate, if that's what this example is run on, by the way. And so even after the recapture, which is the light blue column, the farthest right column on each case, look at the difference between the base case, which is the dark blue, and the with recapture after the depreciation. It's still huge. And the cash on cash is from 6.5 up to 11.6, and the AR from 22 up to 27. And a lot of times it's not that difficult to understand, but it's still nebulous and hard to put a number on. I put some numbers on it. And again, these are assumptions and examples, but this is a real life example. This is what we are expecting on the Bryn Mawr Village project. Any questions on that? Or Bill or Michael, do you have any comments on that?
No, I think you explained it well.
Okay, good.
Does everyone understand? Do you want us to go through what the metrics mean, cash on cash versus average annual return? Or are we comfortable with those?
So, good. They must be comfortable. That's good. All right, so key takeaways: depreciation, cash flow without tax liability, real estate professional status. It unlocks like next level tax savings that you can take advantage of. Multifamily investment just compounds the wealth and the tax advantages. And again, that's just a multiplier effect. It's the same as a single family house. It's just that instead of making $200 a month or whatever it is on each house that you own, you might make $200 a month on the 200 units that you own part of. So it's just a multiplier, but it's the same math. It's the same concept. And remember to always consult with a knowledgeable tax professional. Don't pay more taxes than you have to. Do it legally, but you have to be asked the question. Sometimes it's the medical, like when you go to the doctor. If you don't ask the question, they may not think to bring it up to you, okay? And then you may miss out on the benefit. And so it's important that you take your financial security into your own hands and ask these questions. One thing I think that it's important to remember also, and then I'll be quiet because sometimes I get too excited about this. The federal government, these tax benefits are like incentives to us. They say people in the United States need places to live. We need developers, we need landlords, we need contractors, things like that to build, provide, manage, operate places for people to live. And in order to incentivize them to do that, we are going to give them tax benefits. And what it does then is it reduces the tax you have to pay. The idea is now you have more money in your pocket, more cash, that you can go and build more houses or more apartments or buy more investments. And so everybody wins. That's really why this exists in the first place. It's there for you and you need to take advantage of it. Now, do any of you out there have any investments that you have done this on or think you might want to do it on? And if you don't, you should go buy some. And if you're interested, we have some that you can participate in. And we're always available offline too to talk about this stuff.